In today's video, I am going to be breaking down 5 different ETFs that pay a monthly dividend for passive income in Canada. Let's get down, let's check these out. First one is the North American Financial 15 Split Corp. Now, personally, as a 31-year-old, I would not be investing in this for the long term. I would do this as a short-term investment at this time. However, it is still a very good, I wouldn't say ETF, it's more of a fund than an ETF. However, this is paying an 18% dividend right now, and I had to include it because it is technically a fund, it's just not an ETF. From there, the average volume is 280,000 shares traded every single day, which means that it's very easy to get in and out of it. From there, on the 3-month chart, it is actually down from its high recently anyways, so this could have a nice 40-ish cent jump, or at least I would hope so. However, if we look at the 5-year chart, there is something that we do see, and that is, of course, the continuation of downward movement from its high from 5 years ago, and if you actually go to the max chart, it's even lower from there. This is why I actually dislike split corps, because over time they actually decrease in price. However, their dividend is still massive, so that does offset the fact that you are losing money over time. But we have to also remember that this is getting into preferred shares versus regularly traded shares. Plus, when we're looking at something like this, what we can really assume to is, of course, if you could invest in it with a margin or cash account versus an RRSP or a TFSA, then at least then, if you're still getting your dividend, and it's still a big dividend like it is today, but it's gone down, let's say 10% over a 5-year period, then at that time, you can say, well, I've gained all of this money during that time, and I can use that negative 10% over that period of time as a tax write-off. So it does have some benefits there. And right now it's paying an 11.3 cent dividend. Of course, there are months that it does have lower dividends, hence November of 2020. But also, when we look at historically, even before this, it did have a very miniature increase, or at least higher dividend than it does right now. Its core holdings are, of course, the top 15 financial institutes and its preferred shares, not your regular average everyday shares, which is why it can give you a bigger dividend. Now moving over to actual ETFs, this first one is VDY. This one does pay a 3.8% dividend. It is the Vanguard Canadian High Dividend Yield Index, and this is definitely a fantastic one to hold over time, and I'm going to explain why. But first, it does have an expense ratio of 0.2%, and its average volume is 130,000 shares traded per day, so it's very easy to get in and out of it. If we look at the 5-year chart, we do see that it does tend to trade sideways, at least over the past couple of years until after the virus. However, this reason is because the high dividend stocks in Canada are the Canadian banks, mostly, and because of that, most of the Canadian banks didn't really move before the virus. After the virus, they did extremely well because everyone found out that they can make money even during a recession. Historically, banks really only made money when it was not a recession because there was higher interest rates outside of a recession. However, now, when, of course, this so-called recession is over, then the banks are going to be making even more money because they have figured out how to make money when it comes to ETFs, mutual funds, account fees, things like that. And that's how they've been really basically doing really well during this virus time. However, from there, when we start looking at what they're doing in the future, on top of what they're doing right now, they're going to have higher interest rates, which means they make even more money. I personally believe that banks will be doing extremely well over the next 5 to 10 years, as long as there's no world-burning, world-ending recession. I shouldn't say that there's going to be another virus because, that's the rich and famous shouldn't do that to us again. This one does pay a monthly dividend, and because it holds the largest companies in Canada, I would say it's definitely a safe dividend stock or ETF because it does hold some of the biggest names in dividends in Canada and blue chip stocks at that. If we look year over year, we do see that there was roughly a 30% increase in dividends, which makes sense because, of course, the banks did raise their dividends substantially. And like I was mentioning, you're going to find most of the big 10 holdings in this ETF being the big 6 banks, mostly. Anyways, the number one holding is, of course, Royal Bank of Canada, second being TD. Then you're going to see Bank of Nova Scotia and Bank of Montreal. That's 4 out of the top 5 stocks being out of the big 6 banks in Canada. And then you're going to see CIBC, so 5 out of the top 6 stocks in here is, of course, the banks. And then you're going to see TransCanada, Enbridge. I really do like Enbridge, mainly because it's getting into a lot of the solar panels, wind power, that kind of thing. Well, TransCanada is doing that as well, but not at the same level as Enbridge. From there, BCE, which is a company that I like and dislike at the same time. I just highly dislike telecommunications companies, and that's just my own personal opinion. And then there's Canadian Natural Resources, which they're going to be doing really well this summer because apparently no politician wants to have any kind of mining or anything to do with oil anymore, which is hilarious because that is basically how every single economy, especially Canada's economy, is basically based on. And they can't stop it. So from there, the last one being Manulife. That's another good company in my opinion. I like Manulife. I just made a video about that as well, mainly because there's more and more people getting back to work, and there's more and more people who are starting their own businesses who need to get Manulife to get insurance. So either way, they're a pretty solid company, and overall, you really can't go bad. You could buy Enbridge on by itself as well. It's over 6% dividends, so it's also a good option. Next is the BMO Equal Weight REIT Index, ZRE. So what do we have so far? We've got financials when it comes to the preferred share split corp. We have the top dividend paying stocks in Canada, and now we're going over to the REITs. Notice how I'm kind of organizing this to be a well-rounded, diverse portfolio. This is kind of a good reason because you need to be diverse. You can't just have one single line of income from one sector, because if that sector says I'm finished for the rest of my life, then you're going to lose all your money. If you're diverse, at least you're going to be fine for at least a little while. Anyways, the average volume of this one is a lot lower at 29,000 shares per day on average. However, when we're looking at ZRE or ZRE, you are basically looking at probably not buying 20,000 shares. Like if you were looking at 10,000 shares of this, that's $271,000, and I don't think anyone who's got that kind of money is watching this channel, but prove me if I'm wrong, comment down below. But anyways, yield is 4.2% and the expense ratio is 0.6, so it's really not that bad in my opinion. Over 3 months, it's not done very well. Not that great anyways. However, at the same time, neither has pretty much any rental property in Canada since the virus started, but either way, over the past 5 years, we can see that it has kind of started to create a flag. But either way, it's done pretty well over the history as well as recently. And of course, if this was to actually happen and continue on, this technically has a little bit more room to grow. So, yeah. But to be absolutely honest with you, that looks like it could be breaking out potentially kind of soon. Over the next couple of weeks, this could break out to the upside or it could break down to the downside, but I personally believe it's going to go to the upside, mainly because I'm kind of a person who thinks positively on everything. But at the same time, when we're looking at the Canadian economy, I think that we're going to be coming out of the recession, the virus that we're having right now. I think that there's a lot of pressure that is currently being put on our government officials by pretty much 80%, 90% of the population, even though they want to disagree with that. So from there, I think that we're going to be doing quite well. And then we're probably going to be in for an election federally at the end of the year and provincially in June. So it's going to be very interesting. This does pay a 9-cent dividend, and it's done that for a very long time. It has paid a 10-cent dividend once in 2020. However, before that, it has paid an 8.5-cent dividend. So they do raise their dividend over time, which is fantastic. And we'll just have to continue to see if they continue to do that. Now, the top stocks in this ETF is, of course, the number one is an industrial income REIT, which industrial, I'm not too sure if that's going to be doing very well in the near future, but if we keep on doing online purchases, then of course there's going to be more and more industrial space that's needed, so that is a bonus there. I personally believe that there is going to be a potential downturn in commercial in commercial REITs when it comes to stores. So for example, smart centers, I think there's going to be an issue there. But also when it comes to individual houses, I think that there could be a freeze in price, but that's not really going to matter. And something about REITs that an old friend used to tell me about, basically it was a grandfather to a basketball player who I used to train. He said that the best time to get into rental properties is during a recession, because there's going to be companies that are basically selling their properties, and obviously if you own the properties and the apartment properties, it's the best time to actually own them, mainly because, and this may seem a bit dark, but it's the truth, there's going to be people who are losing the ability to pay their rent and they get to be kicked out, and especially the ones who have been living in an apartment for 5 to 10 years, they generally have a very good rental cost because they can only be increased by a couple of percentage points year over year. However, when they get kicked out, there is new tenants who come in, and when those new tenants come in, the price is substantially higher to market value, mainly because they don't have to go by the same percentage points as they would if somebody was living there. So they actually make more money coming out of a recession than they did going in. So that's why I think REITs are fantastic to buy, especially during a recession. I've talked about this one before, ZWK, covered call US Bank, BMO ETF. This does say 7.2%, but that's because I think Yahoo is trying to do a yearly dividend, because they recently basically reduced their dividend from 18 cents to 17 cents. So that's why that's slightly higher, and who knows if they're going to go back to 18 cents. See, the thing with covered call ETFs is they get their dividend, mostly it's basically capital gains, because essentially how these work is they're selling covered calls against the stocks that they have, which means that that's going to be really dependent on the actual price, essentially, of those covered calls. And if they're not getting the premium that they used to get, then they're going to have to lower their dividend. However, again, average volume of just under 30,000 shares traded per day. Again, that should be liquid enough for most of us who are watching this video. However, if you have had the ability to purchase, let's say 20 or 30,000 shares of that ETF, let me know down in the description or the comment section below, because I'm kind of curious, who could afford to buy 20,000 shares at $34 a share. It's a lot. You're looking at like $750,000, so that's a lot of money. Either way, at 6.2%, that's a very good monthly income. However, as we can see here, it's still a fairly new ETF in a way. It was doing pretty good actually before the virus, but of course since then it's done pretty well. The only issue now is that it's starting to level off, so it's something to kind of watch out for. Maybe pops down to $32 again, might spike up again. It's kind of interesting to watch this one right now. Again, this is what I was mentioning, 18 cents per share down to 17 cents per share. It's because, of course, premiums have gone down. There isn't as much volatility when it comes to options right now like there was at the beginning of the year, or at least last year too. So something like that to keep in mind. And the big banks that they hold are, of course, some of the biggest ones in the United States. We have Bank of America, which is, of course, one that I personally used to own shares in. However, I sold it. I bought it way back when it was like $10 a share, and I sold it at $30 a share, and I'm very happy with myself. Goldman Sachs, I think I was around there, $28, $29, I can't remember. It's been a while. Either way, JP Morgan's another one I like. Signature Bank, I like Bank of America, and I'm going to tell you right now, with interest rates going up, Bank of America usually makes a killing off of interest, so that might be a fantastic one for the future. And of course, I've talked about this one too. This one is a very good ETF. However, this one, keep in mind, is not a monthly dividend pair, but I wanted to mention it because it does have a 10% dividend and the average volume is pretty strong. So think of this one as a bonus, kind of as the first one I was mentioning as well too. The reason why I really want to mention this is, of course, over time it's done extremely well, but there's also another reason why I wanted to mention TXF. ZWT is another fantastic one. ZWT, that's the ticker for the BMO version of essentially this one. And ZWT does pay a monthly dividend. The only issue is it's not as high of a dividend as this one, TXF. However, something to also keep in mind is it does hold different stocks in its portfolio. However, it's the same idea where it's a technology covered call, and that one does, ZWT does pay a monthly dividend. However, again, it's not as high. Now, the reason why I'm mentioning essentially these 6 different funds is, again, we're going from financials that are preferred shares, going to US financials, going to Canadian broad market, going to REITs, as well as technology. These are massive, massive sectors that have the ability to keep you diversified and still pay you a dividend. And mostly all monthly except for this one. However, you can't deny this chart. $10 essentially back basically 10 years ago to $20 today. You're doubling your invested money. You're doubling what you have in there. However, you are gathering a massive, massive dividend. You cannot deny how amazing that is. And that is the dividend. It's grown substantially since 2017, and I hope that it continues to grow as well. Now, these are the stocks that TXF holds, and I personally absolutely love AMD. I used to own it at like $2 or $3 a share, and I sold it when I doubled my money, and I kind of wish I kept it. But either way, Nvidia is another one. Facebook, I absolutely hate. Apple, I have a love-hate relationship. I love the stock, but love and hate their devices both at the exact same time. And then Texas Instruments, which is another one, and I am not a fan of Qualcomm, mainly because of where they are in the world. But I do really like Micron as well. All of these stocks are fantastic to own over time, except I don't think Facebook, also known as Meta, is not really a fantastic option to have right now. I think that they're going to be having some struggles. Anyways, this is my take on, of course, having monthly dividends in your portfolio that pay generally pretty high. Of course, this is my thoughts. These may not be your thoughts. Do your own research. Try to figure out what works for yourself. And of course, I hope that you've enjoyed. Hit that like button, subscribe, and I'll see you guys again next time.